All right, here we go with individual assignment, chapter 23, the last problem. What is that, 13? Yeah, the last problem is 13. This feels a lot like number 10, or it's similar at least, which I guess all of the ones in this chapter are similar in the sense that they cover the same topic. Anyway, so this is the Feeling Better Medical Inc. They manufacture disposable medical supplies, and they prepared the following factory overhead cost budget. And we expect to operate at our normal capacity, which is 5,200 hours. Okay, so here's our variable costs. Here's our fixed costs. Again, these are the budget. So these aren't the actuals. These are what they budgeted. Then it tells us during October, the department operated at 5,500. So 300 more hours than expected. And the factory overhead costs incurred were, and then it gives us all the actual costs. So then it wants us to prepare a cost variance report. So we'll just get to it. So the first thing I'm going to do is I'm just going to record all our actuals, which are in this paragraph right here. So let's see. We had actual indirect factory wages of 17,780. They had actual power and light costs of 12,530. And they had actual indirect materials costs of 10,800. They had supervisory salaries of 9,090 and depreciation of plant equipment of 23,320 and insurance and property taxes of 71,10. So there's my actuals. That's stuff I already know. I can find my total variable cost just by adding these three up: 17,780 plus 12,530 plus 10,800, 41,110. Same with my total fixed, 9090 plus 23,320 plus 71,10, just 39,520. And our total factory overhead cost, which is our total variable cost plus our total fixed cost, 80,630. All right, so that's what they actually spent. Now, a little more complicated is we have to figure out our budget at the actual production. So again, and we did this in a previous problem, but in essence, what we're saying is our normal capacity, what we expected here was 5,200 hours, but we did 5,500 hours, okay? So what we have to do then is figure out what our budget was. So for indirect wages, it was 16,640. Whoops. Okay, if I could type right, 640 divided by the budgeted number of hours, which is 5,200. That means we budgeted $3.20 per hour. Then we multiply that by the actual number of hours, and that will give us our budget at actual production, 17,600. That means if we took our budget, but we adjusted it to 5,500 hours instead of 5,200 hours, that's what we would expect to have spent, okay? And again, we can do that for all of these. So we can take our power and light, 12064, divide that by 5,200, the budgeted hours, and then multiply that by 5,500. Again, you could do this with Excel. It might make your life a little bit easier. It'd be a little quicker. But this is so short, I think we're just going to do it this way. Indirect materials, 9984, divide that by 5,200 budgeted hours, multiply that by 5,500 actual hours. This is 10,560. Now our fixed costs are a little bit different. So let's take a look here, because typically our fixed costs, we don't adjust in the same way, okay? Because we would expect our fixed costs to be the same regardless. So let's see. I think I'm going to go with the pre-existing budget, 90/90 on the fixed costs, on the depreciation, 23,320, and the insurance and property taxes, 7110. Because fixed costs don't usually change just because we had more, hours spent. They're fixed. That's the nature of fixed costs. So I'm going to add up my budgeted actual production numbers, 17,600 plus 12,760 plus 10,560, 40,920. I could add these all up again or see that they're the same. So I'll just do 39,520. And then finally, to get the total, I'll take the total variable cost of 40,920 and get 80,440. Now, this might be a smart time to use one of my checks so that I don't start figuring out all these variances and then find out I had an error. So I'm going to use a check now. Looks like I'm in good shape. So I will go ahead and move on. So the next thing I need to do to find my variances is just take my actual cost minus my budget. Okay. So in the case of my indirect factory overhead, you see my actual cost was higher than my budget, which means I'm going to have an unfavorable variance. So I take 17,780 minus 17,600 gives me a $180 unfavorable variance. I spent more on indirect wages than I intended to. My power and light, 12,530 minus 12,760 gives me a $230 favorable variance there. So I spent less on power and light than I had budgeted to. Finally, indirect materials, 10,800 minus 10,560. So that looks like it's going to give me a $240 unfavorable variance, meaning I spent more than what I budgeted. So then to do my controllable variances here, I'll just add these up. So 180 plus 240 should give me 420. And on the favorable side, I have a negative 230. And so my total controllable variance, 420 minus 230, should be an unfavorable variance of 190. Now it's possible, well, since I did that math in my head, I made an error, so I'll double check. Looks like I'm okay. All right, finally, our volume variance. It tells us it's favorable, so that's nice of them, I guess. To find our volume variance, we're just going to look at the difference in our volume. Remember, our planned capacity was 5,200. We did 5,500. So we'll start with that to find our volume variance. So 5,200 minus 5,500 is going to give us, actually, you know what, before I do that, why don't I figure out my fixed factory overhead rate? And that, I guess you could do it either way, but now that I think about it, that works better for my brain. Okay. So I'm going to just take my fixed costs, 39,520, my budgeted fixed costs, and divide those by my budgeted hours. So I'm going to take 39,520, divide that by the budgeted hours of 5,200, and know that I budgeted $7.60 in fixed costs per hour. And then, since I didn't have any idle hours, in fact, in this case, I went above my normal capacity, right? So I'm going to take my planned hours, 5,200, minus my actual hours, 5,500, which gives me a negative 300. And then I'm going to do that negative 300 times my overhead rate, which I just forgot, but that's okay, because I can figure it out again pretty easy. So 39,520 divided by 5,200. And I'll get negative 2280. Remember, favorable variances come out as negatives. Okay. Oh, you know what? Actually, it's having me do this different. That's going to come out here. It wants the excess hours used over normal at the standard rate for fixed factory overhead. No, I think it wants it there. Okay, so that's what it is, right? Our excess hours is 300 times the rate of whatever it was, 39,520 divided by 5,200. And then it wants our total variance, total factory overhead cost variance, which is going to be favorable. And that's going to be 190 plus negative 2280. So $2,090. So in the end of everything, we had a favorable variance of $2,090, which ultimately means we spent $2,090 less than what we had expected to, given the amount of production we did. I'll check my work and we're all good. So hopefully that was helpful to you. And as always, I hope you have a super duper great week.